Welcome to episode 43 of the Cashflow Connections podcast. Today, we're going to focus on a topic which we haven't covered in a lot of detail in the program yet. It's probably the most fundamental stage of any real estate that's currently standing, and that is, of course, ground up development. There are many moving parts to development. It isn't nearly as simple as buying cash flowing asset and just simply implementing more effective management strategies. And because of that, there are many more things that can go wrong. But if you can execute your plan, stay within budget, and the market dynamics continue to be favorable, the returns can more than make up for the additional risk. So, as our guest says at the end of the episode, don't do this at home. In order to take ground up development properties full cycle effectively, you have to have an absolutely expert team that covers a variety of different skills, but our guest and his firm are certainly up at that caliber. So today we're going to discuss how increased market prices make it challenging to build workforce housing and incentivize luxury development. We're going to talk about some of the key underwriting assumptions that our guest uses to find out if a deal is going to pencil in this current economic climate. We're also going to discuss the stages of real estate development financing. This is going to include a bridge loan, a construction loan, and a permanent loan, and some of the details of those particular loans. And this is really an interesting topic. We're going to talk about recourse versus non-recourse and how certain terms in loan docs can turn a standard commercial real estate non-recourse loan into a fully recourse loan, which could really negatively impact your balance sheet if something were to go wrong. So like I said, we haven't really gone into the details of development yet on this podcast, so really going to be an interesting conversation, and I'm sure you're going to enjoy this one. Also, I am pleased to announce that I am going to be speaking at Freedom Fest 2018, which takes place on July 11th through the 14th at the Paris Hotel in Las Vegas. This is a conference where some of the most well-known freedom-minded people come to share ideas and investment strategies which create the opportunity for more personal freedom, particularly as it relates to investments and finances. I'm going to be joined by some of the most influential minds in the investment space with people like Robert Kiyosaki, Jim Rogers, Doug Casey, and Peter Schiff. And in case you haven't heard it yet, Doug Casey has also been a guest on this program, so make sure to go ahead and listen to his episode, and you'll know why I'm so excited that I'm going to be sharing this conference with him. So if you're interested in being in the same room as some of these great minds, you can go to freedomfest.com/register. And you can also use the promo code CFC FreedomFest for a $100 discount. This is my first time speaking at the conference, but I know several people that have been before. They really enjoyed their experience, and it really motivated me to pursue it. So if you're interested, go to freedomfest.com/register and use the promo code CFC FreedomFest for a $100 discount. All right, hope you enjoy the episode. How's it going, everyone? Today we are joined by Chris Tourtellote, who is the Managing Director of Acquisitions at LaTerra Development, which is one of the most active real estate developers in Southern California. LaTerra focuses on high barrier to entry markets like Santa Monica, West Hollywood, Los Feliz, Silver Lake, and Orange County. They have more than $1 billion in project value across 15 active projects and are currently nearly developing about 2,000 apartment units, either under construction or somewhere in the pipeline, which is just remarkable given the space. So, Chris, thanks again for coming on. I really appreciate it.
Yeah, absolutely. Thanks for having me.
And this is actually the second time Chris has been on the program. So previously, we talked about land entitlement, which is really kind of the first stage of this whole topic, which is development we're going to talk about today. So welcome back, number one. Number two, let's talk big picture first about LaTerra as a whole. Obviously, the first stage of this is kind of the entitlement process, and then it comes over to development. We haven't really talked about that on the program yet. So let's talk about how LaTerra is positioned, both from a land entitlement process and how that land entitlement arm really feeds into the development process.
Yeah, great. I think that's a good topic. And I think perfect way to kind of segue from the first podcast that we did into the second one. So, just as a reminder, what LaTerra focuses on is what we call entitlement risk light. We sort of coined that phrase, which is really smart and managed entitlement risk. So we process as of right entitlements, meaning the intended development complies with underlying zoning. And then secondly, the existing uses often provide in-place income and downside protection. So like a land bank, if you will. And then once our projects are entitled, we then feed them into the next stage, which is the development stage. And so at that point, we'll have a very good land basis because we've probably acquired the site off market. We've now processed entitlements, so we've added a significant amount of value. And then we're building and developing the project. It's a residential and mixed-use project at what we think is a great land basis. So that truly is a good sort of segue into this next stage. So we're a residential and mixed-use developer based here in Los Angeles. We've been developing projects all over Southern California for many years, and the principals at LaTerra have been developing for 30 years. So we've got a great team. We've got institutional experience. We're entrepreneurial. We're nimble, and we have projects all over California. So right now we have a project in Chula Vista, San Diego. It's 97 units. That project is now completed. We have a project in Silver Lake that's completed. We have 228 units in Orange County that's currently under construction. We're in the wood framing stage. And then we have multiple projects in LA County, including Santa Monica, Los Feliz, West Hollywood, Burbank, Silver Lake, downtown adjacent. So we're all over. I think we have one of the biggest pipelines right now in Los Angeles.
Yeah, that's remarkable. Obviously, it's an incredibly large market, but again, it's very challenging for certain operators to find deals. So a lot of it just comes down to your access to deal flow and your vision of the market. So, from a big picture perspective, where are you seeing the opportunity right now when it comes to real estate development in Southern California or otherwise?
Right. Right now it's challenging. We're an urban infill developer, so we like to focus on projects near public transportation, projects that are walkable, close to amenities, and employers. It's all about jobs. It really is jobs, jobs, jobs. So that's why we're focusing on projects in cities like Santa Monica or West Hollywood or Los Feliz or Hollywood or Burbank. These are submarkets where there's a very big supply-demand imbalance, meaning there is a big demand from housing, which is stemming largely from the employers, and there's a variety of supply constraints. So these are the submarkets that we focus on, and we're looking for projects where we can add some value. So we'll buy land that's unentitled. It's zoned for the intended use, but it's unentitled. And we think we can get it entitled and have a very good land basis to then build and do quite well on it. So we're constantly searching for those opportunities. We probably see 3, 4 a day, right? So we're seeing 100 a month, and when we end up ultimately, focusing on maybe one of those a month. So it's a competitive market. There, you have cost escalations. There are other risks that we can get into today that we try to mitigate against, but there are still good opportunities out there, and we're finding them.
Within the development space, obviously, as the market shifts, the strategy needs to shift in order to kind of account for the changing in the metrics. So what are you seeing in terms of which metrics are really driving the change in strategies, and how are you adjusting your strategy to kind of compensate for this increase in prices as the supply-demand disequilibrium is kind of heightened?
I mean, look, a key metric for us is we look at sort of the untrended return on cost that we think we can build to compared to today's cap rate. So that's a metric we look at. You have rising construction costs, and so you need to account for that in your underwriting. And oftentimes that comes out of the land price. Sellers are going to have to accept lower land prices. So negotiating good land prices is important to us. And I think that's one of the reasons why LaTerra has been so competitive in Southern California and has sort of risen to the top, is because we're able to, and we do, and we like to buy land that's not yet entitled, not yet approved, and we take it through that process. We're adding significant amount of value doing that, right? We've done it 20 times in this cycle. We're batting 1,000. We have 100% success rate on entitlements. And my last podcast, listeners can listen to that again to kind of learn how we do that. But I think that's really an important part of it. I mean, it does come back to that strategy, because otherwise you're going to get priced out based on where construction costs are and where land prices are right now. It can be very tough to make deals pencil. So that's a good competitive advantage for us.
Certainly. And one of those key vocabulary words that you touched on there is return on cost. Now, return on cost is not specific to development, but it's definitely a major underwriting assumption in development. They may not apply to some of the more cash flow focused deals that some of the investors may be familiar with. So just so we're on the same page, return on cost is basically a forward-looking cap rate in terms of the amount that you're investing in terms of what the cap rate will be upon the completion and the occupying of that property. So a key metric when it comes to development is the differential between a return on cost and an in-place cap rate or a stabilized cap rate. So what are you looking at right now? What are you seeing in terms of a stabilized cap rate versus a return on cost? And what's that delta that you're trying to achieve there?
That's a great question, right? Because that delta is the gravy. That's why we do all the work, right? So what we like to look at too, just to clarify, is what we call an untrended return on cost. So effectively, what would your NOI be today if you were up and built and stabilized? So no rent growth, no expense growth, just what is it today compared to today's cap rate? So we look at that. Other folks, and we do too, look at what's our stabilized return on cost, which takes into consideration rent growth and expense growth compared to our projection of a forward-looking cap rate. And that's important too. But at the end of the day, I mean, nobody has a crystal ball to know what rents are going to do, what interest rates are going to do over the next few years. So the untrended return on cost is really the gold standard metric. So out here on the West Coast, it's not uncommon for people to be building to 125 basis point spread. So if you have a project in, let's say, Hollywood, and you're building to a 5.25 untrended return on cost, that would give you 125 basis points over today's cap rates of a 4, and cap rates might even be sub 4, but let's say they're 4. That's 125 basis point spread. That's a decent cushion. We at LaTerra, we like to be more closer to 150 basis point spread or even 200 basis point spread. And we've been able to get that 200 basis point spread as a result of our taking entitlement risk. So we like to be closer to 200 basis points. It's tough. It's tough to find those deals, but it is achievable. So I would say 150 to 200 is where we want to be, but I would not recommend going below 125. And that's out here in California in good West Coast markets. You'll hear people in other markets, maybe what I would call secondary markets, and they're of course wanting a wider spread.
Okay, that makes sense. And just so the listeners are on the same page there, so you can go out in Southern California, and this is based on the numbers you were just saying, you can go out and buy a 4 cap in these same markets. But if you're interested in taking on the risk of development, you should be underwriting to achieve a, let's say, 5.25 cap. Now, kind of what Chris is outlining is that they have an additional arm, which is the entitlement arm, which allows them to have a more favorable basis, so they can potentially get up from, a 4 cap to all the way to a 6 cap if they're willing to take on that entitlement risk. So that's really the key there with development. You're obviously taking on more significant risk, but at the end of the day, that's a very significant difference in cap rate if you're talking about a 4 to a 5.25 or a 5.5 or even a 6. So just wanted to clear that up real quick before we move forward. Now, you mentioned some of the current projects you guys are currently developing. What is the big picture, high level thesis of, you mentioned 2 of them. Let's just start with 2 and kind of work around them, talk about the difference between the 2. You mentioned one in Los Feliz. Let's start with that one. Now, what is the high level thesis there? What do you like about the Los Feliz market in particular?
It's a fantastic market. I love Los Feliz. First of all, there has been no new housing built in Los Feliz since something like 1987, which is pretty remarkable. It's been, approximately 30 years. So that's pretty surprising. So we like that first and foremost. It's a very hip market. It's very trendy. It's cool. The projects that we have are adjacent to Barnsdall Park, which is a beautiful park with great views and a Frank Lloyd Wright Hollyhock house at the top. There's 15,000 medical jobs a couple blocks from our project. So that creates great demand. Those jobs aren't going anywhere. And we're within a short walk to a transit stop. So that's another big benefit for the project. So it's transit adjacent. It has great amenities. It's got, an employment center within a very short walk and no new product. So that's a very good market for us.
Awesome. And then I think you mentioned one that you're also doing in Hollywood at this time. What's kind of the big picture thesis there, and what do you like about that market in particular?
It comes down to demand drivers, right? I think there is some supply in Hollywood, but as an example, Netflix is technically their headquarters is in Northern California, but their Southern California headquarters is here in Hollywood. That's really where all the action is. They have a ton of employees. They occupy like 325,000 square feet. At what's called the Icon Tower. So our project is within a short walk of the Icon Tower. So you have a significant job base. We're near transit stop. So those are two key elements for us. We're thinking about employers, and we're thinking about walkability, and we're thinking about proximity to transit.
Have there been any challenges that have come up in these particular developments that are currently underway that have, surprised you? Or, I mean, I'm sure with development, there's so many moving parts. What are some of the key things that have kind of come up during these developments, or generally that you think, investors should be cautious of when pursuing these type of, apartment developments in those high desirable markets?
Yeah, look, there's certainly a handful of risks that we face. I don't want to get too much into entitlements because we had a whole podcast focused on it, but entitlements are always a challenge, right? We're as of right, so we've been able to navigate that successfully. But even though you have a situation where there's such a big supply-demand imbalance, there really is a housing crisis out here in California, and rents are so high. But yet neighborhood groups make it very challenging, and they vocalize their opposition for development. So that's one challenge. And then certainly you have a variety of other market risks like cost escalation risk. And we can talk more about that later. That's a big risk. You have a little bit of interest rate risk, general market risk. And then what I would call cost overrun risk, which is you have your projected budget and you can bust your budget in a variety of ways, right? Anybody who's ever done a home renovation knows the saying, get your top 3 bids and add them all together. Right, but that's not exactly right for what we do. But let me talk about what I think are some of the bigger risks within that sort of cost overrun risk definition. I think when you're going below grade, so we call it excavation. So if you're building a parking garage below grade, you're doing soils excavation, and you really don't know what you're going to find down there, right? It's sort of unknown. So you might come across debris. Folks can come across underground storage tanks. So you really just don't know. And so that's an area of risk is soil excavation. You have a risk that the city inspector walks your project and starts requesting that you make changes, even though you're consistent with your plans. He might want you to make other changes, move things around, add a retaining wall, or who knows, right? So that is a risk. City inspector comments. When you're installing windows can leak and need to be replaced. That's a risk. Anytime you have penetrations in your building, really water leaking is a big risk. Acoustical risks, right? That you don't properly account for acoustics either within the building, so noises people make when they're walking and talking, or the outside world coming in. So those are other areas that you need to focus on. But we have a great consultant team, and we mitigate that as much as possible. And then to the extent you can have an equity capital partner who shares in those risks with you, it goes a long way, right? So I sort of look at it as, 2 types of risk. Is it mechanical error or pilot error? And if it's mechanical error, then that's sort of the unknown, right? Nothing you can really do about it. You could not have foreseen it, and it's not your fault. Versus pilot error, which is really where the developer makes a mistake. So if you have a equity partner who agrees to share in cost overruns with you to the extent that they are mechanical error or unforeseen or force majeure, I think that will put you in a better position.
One of those words you mentioned earlier is cost escalation, and this is something that is obviously a major factor, particularly as it relates to Southern California. So let's talk briefly about that and how that's changed over the last 5 or even 10 years, and how that's really affecting the underwriting as a whole.
Sure. Yeah. So cost escalation, we're talking about increases in hard costs, both materials and labor. And costs have run up significantly. So in 2017 in Southern California, costs rose about 7.5%. Depends on the market, but on average, 7.5%, call it. So that's pretty significant. There's not a lot you can do to mitigate that risk. We do certain things, like in some circumstances, we use design build subcontractors, like MEP, mechanical, electrical, plumbing, or structural, for example, so that we can try to lock in the cost of that early on and cap it. So that's one thing that we do to mitigate that risk. But look, I mean, we're in a market right now where there's just such a demand for labor and materials that it's causing those prices to go up. And then add on top of that, I call it the Trump tariffs, and then, immigration policies, which can make it even tougher. That can create an even more shortage of labor and cause material prices to go up even more in 2018. So that's another concern that we have. How do you mitigate that? I mean, I talked about one way through design build subcontractors, but it's tough to do. You got to have it in your underwriting, and effectively it's when you're buying a site, if you want to make sure that you correctly budget for hard cost escalation in your hard costs, and hopefully you're paying a land price that allows for those escalations to take place. But a lot of people, didn't properly account for that. But the good thing is, hopefully those people also experienced rent growth, which sort of offsets it, right? But you can't count on that. So it's important to keep your eye on it. I expect costs to continue to increase in 2018, but from there it's sort of hard to say.
Right. Yeah, that's a really good point. I think that, as I'm kind of thinking about this, over the long term, cost escalation and rent growth should basically take place in lockstep. But real estate development shouldn't really take place over the long term, right? It needs to be developed as soon as possible. So there may be a significant change or differential in the cost escalation of development as opposed to rent growth, particularly right now when there's such a demand for labor, especially. So it's something to keep an eye on if you're thinking about doing some labor-intensive development or even value add. I recently read a market update that you guys provided, and I swear every time I see something that you guys are putting out, it sounds like there is a major city development that is taking place right next to one of your developments. How does this always happen? And what research do you guys do? That is it just luck in the sense that you're both seeing the same due diligence and you're finding a lot of favorable market economics and demographic changes, and then therefore a city or some major developer builds a massive park or some kind of transportation hub right next to your developments? Or really, how is that continuing to happen? Is it a result of due diligence that you're doing with municipalities? What's driving that?
A good question. I mean, we spend a lot of time selecting our sites. We see a lot of deals, and we think that part of that has to do with due diligence. Part of it has to do with our keeping the pulse of the market, right? We're staying on top of it, our ears to the street. So we get a lot of good data. We get a lot of good information. We have a good network of architects and real estate brokers and friends in the community. And we look at areas that are, great locations, but have development potential. And oftentimes, others see a similar potential, right? People want to be building near transit, near employers. So that's part of it. But it has to do, in part with the fact that we've been here a long time. And we have a really good network of folks. And so we're actively trying to find sites that we think offer the best risk-adjusted returns and that are changing quickly and offer a lot of growth potential while at the same time being well located.
So let's talk about debt, because this is a really interesting part of the development process. This usually involves several different loans. Let's talk about a typical development deal and the debt stack and how it changes throughout the development process.
Yeah, sure. So in some cases, we will acquire a site. Let's say I say it's income producing, right? So maybe it's like a little strip mall with short-term leases. Oftentimes, we'll acquire that with bridge debt, usually low leverage, something that the income can serve. That should be a short kind of, let's say it's a 2-year note. And then from there, we'll get a construction loan, pay off the bridge debt. If there is any bridge debt, pay it off. We'll get a construction loan. Let's say it's 55 to 60% loan to cost. We don't want to be too leveraged. And that loan is really 3-year construction loan term with maybe 2 1-year extension options. And then when the project is built and stabilized, we'll recap out the construction loan with a permanent loan, which is based on LTV, loan to value. So you might have a 55% loan to cost loan at let's say it's $55 million, but when the project's up and built, it's worth $150 million. So if you get, a 75% LTV loan, you're going to be able to pay off that construction loan plus return some capital. So that's sort of the sequence of debt.
And what are the terms on these? You mentioned the loan term, but in terms of interest rates right now, what would a typical interest rate be on those 3 different tranches you just mentioned?
Yeah, sure. Bridge debt, it depends on the leverage on the bridge debt, right? If you want a high levered bridge loan, you might end up paying like 9-10%. But if you keep your leverage low, you can pay, let's say 4 or 5% on bridge debt. Construction financing, it depends. It depends if you're recourse or non-recourse on your construction debt, which is something we should talk about. If you agree to sign on to recourse or a repayment guarantee, you can get, L being LIBOR plus, 250, let's say. So a spread over LIBOR of 250 basis points. There are some good non-recourse lenders out there at, let's say, L plus mid to high 3s or low 4s. That's sort of the construction financing. And then, permanent debt, again, it just depends on the leverage levels, but it's right now it's pretty tight. I mean, you're going to be in the, let's call it low to mid fours on permanent financing.
Mm-hmm. You mentioned the kind of discussion between recourse and non-recourse. This is obviously a critical part of this discussion when it comes to loans, especially as it relates to construction. So what are some of the first of all, let's give just a brief rundown of recourse versus non-recourse, and then we can get into what terminologies which can be included in these loans, which can really make the difference of whether the developer is going to suffer significantly or whether they're going to be all right. So let's talk briefly about that and then get into the details.
Yeah, sure. So recourse means that you're providing a repayment guarantee. So effectively, you are guaranteeing to the lender that you're going to repay the full principal balance of that loan. So that's certainly a higher risk loan. A completion guarantee just guarantees to the lender that you're going to finish building it. So if you have your equity in place and the construction lender's funding, you're just guaranteeing that you're going to complete construction of the asset. So effectively, you're guaranteeing cost overruns and you're guaranteeing that you're going to complete construction. Most loans also contain non-recourse carve-outs, meaning like if you do bad acts, then the loan can become recourse. Environmental indemnities is sort of another form of recourse, but the big one is recourse versus non-recourse construction. It's important to understand that. Most lenders want to be recourse, but there are a handful of really good, really strong, smart, non-recourse construction lenders out there who are pretty active in the space right now.
I have read many loan terms, and I have seen non-recourse loans that turn into recourse in the event of a myriad of different actions. Not only actions that I would consider, not necessarily bad actions, but I mean, one that's quite common is that it turns into recourse in the event of a default. And I'm thinking, well, that's the only time that it matters anyway. So, I mean, have you seen terms like that where, it's considered a non-recourse loan, but turns into recourse if there's a default and there isn't a payment within 30 days or something like that?
Yeah, Hunter, you are spot on. Backdoor recourse, right? So we see that frequently. So, hey, this is a non-recourse loan. However, if you do any of these things, it becomes full recourse to the guarantor. And then you start to read through the list of things, and it could be, misapplication of funds. So not misappropriation. Misappropriation is a bad act, but misapplication of funds. That could be an accounting error, right? Or they could allege it. Boom, full recourse. Not maintaining the property. Not like a casualty, but what does that mean? Not maintaining the property, right?
Mm-hmm.
You could sign a lease that could technically be considered a transfer event. Boom, the loan becomes full recourse. So there's a variety of items that I would call backdoor recourse. And so we spend a lot of time negotiating the non-recourse carve-outs. It's important to really focus on that language and to make sure it isn't backdoor recourse. Here's another interesting one, not just for recourse, but just for the listeners to understand. When you are agreeing to a loan, there's something called a MAC clause, Material Adverse Change, MAC or MAC clause. So with a MAC clause, a lender can say, hey, the market has changed. There's been a material adverse change. My 55% loan to value loan is now 65% because the value has dropped. Therefore, you need to give me a $10 million pay down. Whoa, right? So that's out of my control as the borrower. So we do not like MAC clauses. And in certain circumstances, we've agreed to certain language within a MAC clause, but not economic changes. So that's an important one. And that can show up in the non-recourse carve-out section as MAC clauses. So got to be careful for that. And then just one other comment on this topic is that oftentimes, how are these loans guaranteed, right? You say you're going to guarantee it. A lender won't allow you to put up a shell company, an LLC, just, form an LLC. It has no assets. No, the lender's going to want to have a certain amount of net worth and liquidity. Typically, they're going to want the net worth to be, let's say, 75% of the loan amount and liquidity to be 5 to 10% of the loan amount, right? So if you have a $100 million loan, they're going to want, let's say, 75%, $75 million of net worth and 5 to 10 million in liquidity. So you got to have a guarantee entity with some significant assets. In other cases, a lender will say, we want a warm body. What does that mean? It means an individual, right? Somebody with a pulse. And they're going to say, hey, it's not, companies don't make decisions. people do. And so we need a warm body to be on the non-recourse carve-outs. Well, that's pretty scary. That'll keep you up at night, and that's what the lenders want.
Yeah.
But if you have a corporate entity as the financial backstop, then why should an individual be the financial backstop? The one I think, caveat to that is, certain very bad acts maybe can go to a warm body, and then bankruptcy, right? Voluntary bankruptcy, where you're throwing an asset into bankruptcy, that can go to a warm body. But it's really important to understand this stuff and to focus on it, because it's really, I think that's one of the biggest keys to development is being able to satisfy lenders, being able to sign on to the guarantee, having the net worth and liquidity, whether it's your entity or you have to get, a co-GP or some other development partner to satisfy it as you grow. But it's, I've sort of seen it all, and we've evolved into a pretty strong position today, but it's a very interesting and important component of what we do.
Obviously, interest rates are going to play a major role in the entire debt portion and therefore the entire purchase price and underwriting assumptions, et cetera. What are you seeing right now in terms of interest rates? Where do you see this environment going in the next, let's say, 2 to 5 years?
Look, interest rates are low right now, and they're probably going to rise. One thing to keep in mind is that when the Fed raises rates or causes rates to be risen, it typically happens on the short end of the curve, right? Like LIBOR, for example. As opposed to the long end of the curve, like the 10-year note. And so it's, that's one thing to keep in mind. It doesn't necessarily mean, 10-year rates are going to rise at the same rate. Another thing I think about is that when rates rise, it's oftentimes a result of a strong economy, right? And so what happens when the economy gets stronger? You have more capital, right? More people have more capital looking to do a smaller number of deals. That pushes cap rates down, and then rates rise. Okay, so that will cause cap rates to go up. But if the economy is strong, maybe maybe cap rates stay flat or stagnant. So it's not always one-to-one. It's sort of an interesting puzzle. So where do we think the market's going to go, and how does this all connect? It's markets are both national, but they're very, very local, right? So what event nationally or globally, like war, for example, could cause a recession? It's hard. It's hard to predict what can cause or what will cause the next recession. But I always ask myself, well, how is that going to impact real estate development, or more particularly, apartment and mixed-use development in Southern California? It's a hard question to answer, but I'll tell you this, that right now there's a housing crisis in Southern California. You have a huge demand for housing. You have very strong employment in California. You have a variety of different industries as demand drivers, everything from technology, education, finance, real estate, insurance, manufacturing, leisure and hospitality, government, et cetera. I could go on. So there's a very diverse set of demand drivers. And then you have all these supply constraints. It's very challenging to get things entitled here, to get things built, and you have geographic constraints as well. So I think that we're well positioned here in Southern California, and any of the listeners who are located here, I think, should feel pretty good about the dynamics here. And then certainly there's other markets around the country that have similar dynamics. So a lot of it is local.
Certainly. I think the key is that the debt portion is such a significant role player in the entire purchase price that's really where it comes into the national market as a whole, right? So you think about things like interest rates, for example. California can have an incredibly favorable supply-demand equilibrium, but if interest rates significantly go up, and your point is well taken regarding interest rates rise typically during favorable economic conditions, I guess, my real question is, do you see a downside? Where do you see the downside? Let's say that things turn around in the capital markets or otherwise. You mentioned war, for example, a black swan that we have really no control over and has nothing to do with the supply demand. Where do you see there? How much downside do you see when it comes to Southern California real estate in the asset classes that you're focused on? Right.
Well, look, in this cycle, rents in markets like San Francisco and New York have risen about 52%. In LA, they've risen about 42%. So there's still some growth, but the tree doesn't grow to the sky, right? Rents aren't just going to grow forever. So incomes have to keep up. So it's important, that incomes keep up. I think, in some markets and some asset classes, there is more downside than upside. And that's why we have to be really focused. I think in Southern California, for well-located sites near employment, near transit, I think there is still upside, but asset selection becomes, very important. So we want to make sure that we have assets near strong employers where incomes are high, and there is still some upside. So that involves seeing a lot of deals. And look, we've become and we've transitioned into a long-term holder of assets. And so therefore we want to build and hold so that if there is a downturn, if rents do drop, we can hold the assets through the downturn. I think in the last real estate cycle, let's call it like 2008, 9, 10, rents dropped something like 11 or 12% in LA, and vacancy rates went from something like 4 to 5 to kind of 7. So LA was somewhat recession resistant compared to some other markets, so that makes us feel pretty good. But you want to keep low leverage levels, and you want to be well positioned. And then kind of on a similar but related topic, luxury housing versus workforce housing, right? What does that mean? So far in this real estate cycle, something like 70% of the construction has been what I'll call luxury housing, very high-end, Class A housing with expensive rents. What about workforce housing? That sector's been left behind. What do I mean by workforce housing? I do not mean, quote, affordable housing, which is an official designation, but housing for teachers, housing for police, housing for bus drivers, right? These are critical members of our society, and they need places to live, and they can't afford $3,000, right, for a one-bedroom. So it's important for developers to focus on the workforce housing sector, and that is, I think, more recession resistant as well. But that's a challenging sector right now. Why? Because land prices are so high and construction costs are so high that it becomes economically unviable to buy land and build a product where you can offer low rent. So it's sort of an interesting paradox. But we are looking to do some workforce housing. We have our project in Chula Vista, San Diego, which we broke ground on in 2016. It's a very nice product, very good, 2% vacancy in that submarket, but it's catered to workforce housing. And we're looking at some stuff right now outside of LA, not the Inland Empire, but sort of halfway in between, call it like second, third ring locations. So those are areas where you can still build 2- and 3-story walk-up product, surface parked, and buy land at reasonable values. And I think those strategies are going to be important as well.
Yeah, I'm really glad we got to touch on the distinction there between luxury housing and workforce housing. It's incredibly important, particularly as it relates to California, but also nationally speaking, as prices rise, just to kind of summarize your points there, as prices rise, it becomes more and more challenging to make those workforce housing developments pencil. So workforce housing continues to be recycled, and people are implementing value-add properties on B-class, C-class properties, turning them into A-class properties, and there's less and less affordable housing available. So it's going to be something that's really going to come to an head here if prices continue to inflate. That's one of the reasons I focus on, not necessarily affordable. I focus on mobile home parks, right? Because there's such just a supply-demand equilibrium, and it's very challenging to develop affordable or even workforce in this environment. So, before you run, I wanted to hear briefly any horror stories that you had that you'd be willing to share, of course, related to development. Like I mentioned, this is something that I don't have a tremendous background in, but I'm interested to hear, something that took place that you were able to mitigate, or something that you weren't able to mitigate, whatever you think is appropriate.
Yeah, sure. I mean, I think probably the biggest horror stories in development center around cost overruns, right? I'll give you 2 examples of projects. These weren't projects LaTerra worked on, but these are projects of sort of friends in the industry. The most interesting example is a project where the developer was excavating, right? So he was digging his hole below grade for the subterranean parking garage, and he came across bones, and they were Indian bones. It ended up being an Indian burial site. So what did he have to do? He had to put the project on hold, and ultimately an Indian shaman had to be called in to bless the site, and get some compensation, I guess. And ultimately, that process took a very long time. I don't know how long they were stalled for. Let's say it was like 12 to 18 months. So that's sort of the most extreme example.
Wow.
But look, I mean, you just don't know what you're going to find when you go below grade. And I think another example is waterproofing, right? If you install windows and they continue to leak, or another portion of your project is leaking, and oftentimes the general contractor can point fingers at the subs and they say it's their fault and they're pointing at someone else, and then you're trying to get an insurance claim. I mean, that can be challenging. So I think, constructability, and cost overruns, those are horror stories. And then, you hear some stories about people who are getting projects entitled, but they're asking for like a zone change or a general plan amendment, and their project gets sued or whatever. So those are challenging as well. But look, it's a risky business, right? And that's why there's got to be some margins here and some room for profit. Don't try this at home.
Right. Well, Chris, again, I really appreciate you coming on and sharing all of this incredibly dense information with us. Before you go, do me a favor and let some of the listeners know how they get in touch with you and learn more about your firm.
Yeah, absolutely. That'd be fantastic. Always happy to chat and learn more. So our website is LaTerraDev.com, www.LaTerraDev.com. And then listeners can send me an email, Chris Tourtellote, so Chris and then the initial T, at LaTerraDev.com, LaTerraDev.com. And that's my email address.
All right, Chris. Well, thanks again for coming on the program. Much appreciated.
Yes, thanks for having me.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC, because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.